So guys, welcome back. I'm here with Bob Sanders again. On today's video, we are gonna just dive in a little bit more about the interest rates, which are a little high right now.
Yeah.
Right?
They're a little bit high, but if you look historically,
Yes.
they're not bad.
What? Bro, what are you talking about, man?
For those of us who have lived longer and they know and they know how high they were, we have not lived through that period,
No.
so we have no sympathy.
I have sympathy. I do have sympathy. But yeah, my first mortgage was a 5-year ARM at 7.5%, and I was happy to get it because fixed rates were 11% at the time. So it's all relative.
See, if you're feeling down, just speak to your elders, and they will remind you of
How hard things used to be.
How hard things used to be. No, seriously now.
I know.
So Bob, no, seriously. Interest rates, like, it's really affecting because we came like from a time where it was really low.
Right.
And then, so just as an example, it's like when we talk about 1% increase, what does that like impact on the purchasing power of people, like with a
Right.
1% increase? For people to have an idea, how much more money you're talking about? Like if you're buying a $300,000 home, 1% increase, how much more you should be expecting on your mortgage?
Yeah, it depends on how much you buy, obviously, and what the interest rate is, but it definitely can make a big difference. That 1% can translate to hundreds of dollars more a month, depending on the loan amount and what you're borrowing. So it's mindful to definitely get the best interest rate, but it's not just the interest rate right now. It's like, what's your long range plan with the house?
Okay.
But yeah, so what can affect interest rates? What can really affect interest rate? Credit score. That's the number one thing I tell people all the time is know what your credit score is. Know how your credit looks. I can't tell you how many people, I had it happen today. I pulled their credit and I was going over the credit report with them, and they're like, where did those collections come from?
Yeah.
I didn't have anything pastel, I never had anything. Well, unfortunately, a lot of stuff happened during the pandemic with people's credit that they weren't aware of, and unfortunately, they're finding out now when they're trying to buy houses. So credit's number one.
So, okay, Bob, so credit score, I think like that's what everybody knows, that it's like you need to have a good credit. But then sometimes like only having good credit doesn't necessarily mean that you're going to get a low interest rate, right?
Correct.
So what is the next thing? So like that it could impact the interest rate on your loan.
Right. So the other factors that affect your interest rate are going to be, like we said, the credit score, then debt to income ratio. How much debt do you have to your income? And obviously, the lender will make an analysis of that. But if you have a higher debt to income ratio, that can cause a higher interest rate. So it really just depends on the product and depends on you individually. That's a big factor in it also.
Okay. Because then like you can have good credit, pay all your bills on time. But then if you have too much debt for what you're bringing monthly home, that can impact as well.
Right.
How much of your money that you bring every month should be going to debt? Like to be in a good place.
Right. So I'll just tell you where the limits are as far as how high we can go. We can actually go up to 50% of your gross monthly income can be debt. Now that's all in. That's your mortgage payment, your car payments, credit cards. The max is 50% debt to income ratio. You're better off and you get better pricing if you get below that, more like in the 43% range.
Okay, all right.
So whatever your gross, a lot of people get confused about that. It is based off your gross income. So how much you get before you pay taxes or anything. As long as you stay around 43%, you're gonna get the best interest rate on that, from that standpoint.
So 43% of your monthly income should be the max going to pay. And when we talk about that, it's like your car payment, credit card payments, or the mortgage, insurance, all that kind of stuff. It's not just credit card debt. The bills that you have to pay.
The bills you pay. Student loan debt. That's another thing.
Yes.
A lot of people had student loan debt that was deferred during the pandemic. Well, they now are releasing those and they have to start making payments on them again. So that has to be calculated in also.
Cough.
Thank you. I know, I was trying to... I'm like, what's he saying that for?
Okay, so those are the two things. Credit score, debt to income, but then there are other things that are like, that is part of the transaction that might affect the interest rate, right?
So the next thing is loan to value. How much are you borrowing based on the purchase price of the home. The higher the loan to value, which in another video we talked about, you can actually sometimes go up to 0% depending on the home and what you're doing. But the higher the loan to value, typically that affects the interest rates negatively also. Not always,
okay,
but again, that can do it too. So that's another thing, you balancing how much to put down compared to what the interest rates you're going to pay. So you have to look at the cost holistically on this.
Yeah.
So definitely loan to value. And obviously the loan to value is decided on the loan amount that you select, which a good lender is going to give you options and talk to you about the decisions you make on how much to borrow. But that obviously affects the interest rate also when you're deciding.
So Bob, like we talked about like things that will impact the financing, the interest rate for the financing.
Right.
And then of course, credit score, debt to income ratio, the amount of money that you're going to be borrowing to purchase that property. But then when we start getting into a place where we have like the interest rates are higher, there are some ways that we can kind of like beat that system a little bit.
Yeah, I don't know if you're beating it,
just you're paying it. Everything comes with a risk.
Sure.
Everything comes with a risk.
Yeah.
But then like this is why we rely on professionals kind of like to tell us,
right,
it's like where we should stand. So
one thing that's interesting about interest rates, you know, most people are used to 30-year fixed rate mortgages. That's the predominant mortgage that's done in the United States, is a 30-year fixed rate mortgage. But there are other options out there. There's 15-year fixed rates. There's adjustable rate mortgages, which I wanted to mention, because the interesting thing is adjustable rate mortgages work because they're fixed for a set period of time, and then after that period they become adjustable. So there is risk because obviously when that fixed period's over, rates can adjust and they can go up. The interesting thing is, if you look at the life of the average mortgage in the United States, it's about 7 years. So most people keep their mortgage on typically 7 years. Now that may be because they sell their property, they refinance their property. Hey, I need to get money out because my child's getting married or some other major expense. So a lot of what I'm telling people right now with the higher fixed rates, higher than what people are used to, is look at adjustable rate mortgages. And I'll just give you an example. I was talking to a customer yesterday, 30-year fixed rate mortgage was about 6.25%, but I had a 5-year ARM at 5.5%.
okay.
So for 5 years, they were going to be making a lower payment on that. But with this customer, they knew that they probably weren't going to stay in this house longer than the 5 years.
Okay.
That they were just going to be working this one job and relocated them here, and they'd probably be moving someplace else. So it definitely makes sense for them to do that.
Yeah.
Also, they can actually qualify at that lower rate. So let's say someone's, having trouble qualifying because of their debt to income ratio. Well, we may be able to put them in an ARM to get their qualifying rate lower, and then they can buy the home. And you can always refinance mortgages later. I tell people all the time, and this is nothing new, marry the house and date the rate. Because we can always change that rate later on.
Marry the house, date
the rate.
Explain. But this is really good information, because it's like there's other options even with the ARM, because your payments are going to be lower. It can help you qualify for mortgage for that time, taking in consideration how long you'll be planning to be staying in that place, right? Understand also, guys, that everything is a risk. It's like we are trying to not beat the system, but be smart on taking advantage of the resources that are given to us. So what is the buzz out there about what's going to happen with the interest rate? I heard it's going to go to 15%.
Yeah, that's not going to happen. Obviously, nobody knows. If they really know, they would live on an island. They wouldn't be, worried about financing. But yeah, the projections are that rates will adjust. Obviously, the rates change every day. And the thing right now is battling inflation. So right now, the government's trying to figure out how much to raise rates to slow down to help with inflation. But the long-term predictions are that rates will come down.
Wait, what? What did you say?
Rates will come down.
Repeat.
Rates will come down.
Yay! We all knew that.
Yeah, I know. But, the thing is, when rates come down, as you know, then there's more buyers out there trying to buy houses.
Yes.
So while this may seem like it's higher interest rate time, it's probably a good time to be looking at houses now.
And that's what people are not understanding. Like when it's like, oh, the interest rates. At the end of the day, it's like the market will kind of fluctuate because you still want people to be able to afford a home, right? And to be able to purchase a home. So that's why, like in a market like we are now, you see more homes like going through price reductions and this and that. But once the interest rates go lower, then we might be living in a situation that every house will get 20 offers.
Right.
We don't know exactly, but that can happen, and then the prices will go higher because there will be more people looking for homes.
Right.
So even if you're selling or buying, and if you're choosing to buy right now to go from a house, it's like it's going to be the same almost.
Right.
The house that you're going to sell might be more, but the house that you're going to be buying is also going to be more.
Right. And there's also what I tell people too is, you have to balance risk with cost.
Yes.
Too.
Yeah,
you're paying maybe a little bit more for a house later on, but the value is going to go up.
Yeah.
And that cost is going to be offset by the money you're making on the value of the house.
On the value of the house.
Right.
Yeah. So the one thing, Bob, that I say, like when it comes like to buying a house, because it kind of involves everything, the interest rate. I think like when you're buying a house, what you have to look is how much money you're going to pay per month. How much is going to cost you to live in that house?
Right.
So if I lose my job, if I go to a job that I'm not going to make as much money, will I be able to keep my house? This is what I think people like. It has to be the guiding light for you when you're buying a house. Because I have clients and we work with them where we know that they can afford even more what they are choosing to buy, but they're being smart because of so much of things that can change. We don't want our clients to be going to a place where they're going to be going like freaking out. What ifs.
Right.
So we really want people to have like that conversation with themselves. It's like where I'm going to be comfortable. It's not about like what everybody else thinks we should do. Right. It's about what is going to be comfortable for you.
Like you said, I just want the customers to be comfortable with what they've selected and not be worried about, can I make that mortgage payment? Some people have higher risk tolerance than others, and some people are like, I want to borrow the max, I want to buy the biggest house, I don't care, I want to get into it. But it just depends on your personal preferences on what you feel comfortable.
All right, guys. So if you want to know more about adjustable rates, adjustable rate mortgages, so we're going to do another video. So if you want to just dive in more about the whole buying financing, just click on the video next and then you can learn a little more. Bye, guys.